Here's a number that should be impossible. About 1 in 5 Americans over 50 has zero retirement savings. Not a small nest egg, not a modest 401k, nothing. And yet every single year, millions of them retire anyway. They don't retire because a financial planner told them they were ready. They retire because their body gave out, their employer let them go, or a spouse got sick. So what actually happens when you reach 65 in America with nothing in the bank? There's an entire economy built around that question, and today we're going to follow the money through it. For most of American history, retiring with nothing wasn't the exception. It was the default. Before the 1930s, if you were too old to work, you moved in with your children, or you kept working until you died, or you ended up in a county poorhouse. Old age and poverty were basically the same word. Social Security, created in 1935, changed that. It was designed as a floor, not a full income, just protection against what President Roosevelt called a poverty-ridden old age. The idea was a three-legged stool. Social Security was one leg. A company pension was the second. Your own savings were the third. Here's the problem. Two of those legs quietly disappeared for a huge share of workers. In 1989, about half of working households in their 50s had a traditional pension, the kind that pays you a guaranteed check for life. By 2022, only about a quarter did. Pensions were replaced by 401k plans, which are savings accounts you fund yourself through your employer, and IRAs, individual retirement accounts you set up on your own. That shift moved all the risk from companies onto workers. If you never had spare money to save or your job never offered a plan, and roughly 57 million American workers don't have access to one at work, you arrived at 65 with one leg of the stool, sometimes not even that. So the economy of retiring with nothing exists because the system was rebuilt around voluntary saving, and tens of millions of people, for very ordinary reasons, couldn't volunteer. Let's define what nothing actually looks like. According to the Federal Reserve's Survey of Consumer Finances, the median household approaching retirement, ages 55 to 64, had about $185,000 in retirement accounts. But that's only among households that have accounts at all. Just under half of American households report any retirement account savings whatsoever. And a AARP research found that about 1 in 5 adults over 50 has saved nothing for retirement. The averages you see in headlines, sometimes north of $500,000, are pulled up by wealthy households. The median tells the real story, and for a huge slice of the country, the median is a number very close to zero. Now, what does life cost on the other side of retirement? Advocacy groups like the Senior Citizens League estimate that a typical single retiree needs roughly $2,700 a month to cover rent on a one-bedroom apartment, food, utilities, transportation, and health costs. Call it around $32,000 a year, more in expensive states, less in cheap ones. And what does a retiree with no savings have coming in? Social Security. The average retirement benefit in 2026 is about $2,080 a month, just under $25,000 a year. But that's the average. If you spent your career in low-wage work, your check can easily land closer to $12,000 or $15,000 a year. The gap between what life costs and what the check pays, somewhere between $500 and $1,000 a month for many people, is the core math problem of retiring with nothing. Housing is where that gap bites hardest. More than half of renters age 65 and older, about 58%, spend over 30% of their income on housing, which is the government's definition of being cost-burdened. Millions of them spend over half their income just keeping a roof overhead. When rent takes the first 50% of a fixed check, everything else, food, medicine, the electric bill, competes for what's left. So who makes money in this economy? More players than you'd think. Start with work, because for millions of older Americans, retirement isn't the end of employment. In 2025, about 19% of Americans 65 and older were still in the labor force. That's roughly 1 in 5, up from about 13% in the year 2000. Among people 65 to 69, it's about 1 in 3. Some of them love their jobs. But surveys consistently show that a large share keep working because they can't afford to stop. Employers, especially in retail, delivery, caregiving, and food service, have discovered a reliable, experienced, and often desperate labor pool. The greeter at the big box store and the 70-year-old ride-share driver are not lifestyle stories. They're the labor market absorbing a savings shortfall. Next, the lending industry. When income runs short, older Americans borrow. Credit card debt among adults over 50 has been climbing, with average revolving balances running around $8,000 among those who carry them. Interest rates above 20% turn a grocery gap into a compounding liability. Then there's the house, for the minority of low savings retirees who own one. Reverse mortgage lenders offer to convert home equity into monthly cash, collecting origination fees, insurance premiums, and interest that compounds against the estate. It's a legal, regulated product. It's also a business model built precisely on people who have a house but no money. Then the benefits economy. When seniors fall far enough, government programs catch some of them, and entire industries organize around those programs. Medicaid, the state and federal health program for people with low income, becomes the payer of last resort for long-term care, and nursing home operators build their business models around Medicaid reimbursement rates. Supplemental Security Income, or SSI, a federal cash benefit for the poorest seniors and disabled people, pays about 2.5 million older adults an average of roughly $610 a month. Food assistance, subsidized senior housing, Medicare savings programs that cover premiums, each has its own bureaucracy, its own waiting list, and in some cases, its own ecosystem of brokers and advisors who get paid helping people qualify. And notice the direction of every flow. Wages flow in from continued labor, interest flows out to lenders, equity flows out of the family home, and public dollars flow through providers, landlords, and insurers on their way to the retiree. Almost nobody in this chain is villainous, but almost everybody in it gets paid before the senior does. So who actually pays for a retirement with no savings? Follow the order. First, taxpayers through Social Security. About 78% of retired Americans say they rely on Social Security to cover necessary expenses. For roughly 4 in 10 beneficiaries over 65, it provides at least half their income. For more than 1 in 10, it's essentially all of it, 90% or more. Social Security keeps over 16 million older Americans above the poverty line. It is, by a wide margin, the most effective anti-poverty program in the country, and for the retiree with nothing, it isn't a supplement, it's the whole paycheck. Second, taxpayers again, through Medicaid and SSY, but only after a test. To get Medicaid to pay for a nursing home, you generally have to spend down almost everything you own, in most states, to around $2,000 in countable assets. The system doesn't rescue you from poverty. It requires poverty as the price of admission. A lifetime of small savings, the modest house, the little bank account, gets consumed first. Then the government steps in. Third, the family. This is the biggest hidden payer. Adult children cover rent shortfalls, buy groceries, pay for prescriptions, and eventually provide care themselves. Unpaid family caregiving in America is worth hundreds of billions of dollars a year in labor that never appears on any invoice. A daughter who cuts her hours to care for a mother with no savings is paying twice, once in lost wages now, and again in her own smaller Social Security benefit and thinner 401k later. Retiring with nothing is rarely a one-generation event. It echoes. And fourth, the retirees themselves, in the harshest currency. They pay by working at 72, by skipping medications and dental care, by choosing between rent and food, and at the extreme edge, by losing housing entirely. People over 50 have grown from about 10% of the homeless population 2 decades ago to roughly half of it today, and researchers project homelessness among older adults will keep climbing sharply through 2030. That is what the bottom of this economy looks like. The visible costs are rent and groceries. The hidden costs are quieter and they compound. Start with health. Medicare, the federal health insurance program for people 65 and over, is not free. Part B premiums come straight out of the Social Security check before it ever hits the bank account, and Medicare doesn't cover most dental, hearing, or vision care or long stays in a nursing home. A retiree with no savings doesn't have a cushion for a $1,500 dental bill, so the tooth gets pulled instead of fixed, or nothing happens at all. Skipped care isn't a savings. It's a deferred cost that comes back bigger, often as an emergency room visit that taxpayers end up covering. Then there's the claiming trap. Workers can take Social Security as early as 62, at a permanent reduction of up to 30%, or wait until 70 and get a benefit that's substantially larger for life. People with savings can afford to wait. People with nothing usually can't. So the poorest retirees systematically lock in the smallest possible checks for decades precisely because they were poor at 62. The system quietly pays the least to the people who need the most. There's the cost of financial fragility itself. No savings means no buffer. So every surprise, a car repair, a rent increase, a furnace failure becomes debt at credit card rates or a payday-style loan. And older Americans on fixed incomes are prime targets for scams and predatory products, from fake sweepstakes to overpriced insurance, which drain billions from exactly the households that can least absorb it. And there's the family ledger: lost vacation days, plane tickets, siblings arguing over who covers mom's rent this month, careers paused in peak earning years. None of it shows up in retirement statistics. All of it is real money. Why does America produce so many people who retire with nothing? Because the system is doing roughly what it was designed to do, and the design has a gap in the middle. American retirement policy made a bet in the 1980s: replace guaranteed pensions with individual accounts and reward saving through tax breaks. That bet works beautifully for steady, well-paid workers at large employers. The tax advantages of 401ks flow overwhelmingly to higher earners because they're the ones with money to shelter. For low-wage workers, workers at small businesses, caregivers who left the workforce, and anyone whose life included divorce, illness, or a layoff at the wrong time, the structure offers very little. The outcome isn't a malfunction, it's the distribution the design produces. Meanwhile, Social Security was never sized to be anyone's entire income, yet that's exactly the role it now plays for tens of millions. And its main trust fund is projected to run short in the early 2030s, which under current law would mean automatic benefit cuts of around 20% unless Congress acts. For a retiree living check to check, that's not an abstract policy debate. Other wealthy countries made different trade-offs with higher minimum public pensions or mandatory saving systems and generally see lower old age poverty. America chose lower taxes, more individual responsibility, and a thinner floor. Every year, about 4 million more baby boomers reach retirement age and land on whichever side of that design their working lives put them. So what does the economy of retiring with nothing actually deliver? A floor, but a low one. Social Security genuinely prevents mass destitution among the elderly. That's a real achievement, and it's worth saying plainly. But the floor sits below what basic life costs in most of the country, and everything that fills the gap — extended work, family money, consumer debt, home equity, spend-down programs — comes with its own toll collector. The winners are the industries positioned along the gap: lenders, low-wage employers, reverse mortgage originators, and providers built on public reimbursement. The people who pay the difference are taxpayers, adult children, and above all, the retirees themselves in longer working lives and smaller ones. Here's the thing to remember: retiring with nothing is not a rare personal failure. It's a mass outcome, 1 in 5, produced by a 40-year redesign of how Americans are supposed to save. In this country, old age has a price of admission, and millions of people are paying it 1 month at a time. If this breakdown helped you understand the system a little better, a like helps more people find it, and subscribing means you won't miss the next one. Thanks for watching.